Right, let's check in on shares in Alamos Gold. They came under pressure today. I know it's a down day for gold generally, but losing about 9%. Looks like investors didn't love the latest results. Let's bring in John McCluskey, President and CEO of Alamos Gold. Now, John, I know the stock price went up about 45% in the quarter, so you have lots of happy investors. There's no doubt about that. But it looks like people didn't love the latest quarter. Why do you think they're selling today?
No, we got taken to the woodshed today, but no doubt about that. We came in at the very low end of our guidance, and our costs, mostly unrelated to operations, but our costs were higher than guidance. So that's not typical of Alamos. We've gone through something like 15 straight quarters now where we've either met or exceeded guidance for both operations and on costs. So for us to come in with a quarter like this is not very typical and not what certainly not what investors would expect.
So your earnings were below expectations. Part of that was stock-based compensation, I think, after the shares soared 45% in the 3 months.
Yeah, a lot of companies, they hedge their exposure to stock-based compensation, and we don't do that. And so if you essentially see it all valued in one quarter like that, it's all mark to market. So this is compensation granted over quite a number of years. We go back as much as 5 years, and those options or PSUs and so forth will still be intact. Mm-hmm. That basically all gets mark to market in the quarter, and that inflated our costs quite significantly this quarter.
You had higher royalties. Now, why was that? Is this an old royalty deal that you have on your assets?
No, we actually, on average, we probably have lower royalties on Alamos mines, Alamos production than the industry average. But it's all effectively, again, mark to market. So if the gold price goes up, we pay more on those royalties. The gold price went up significantly over the course of the quarter, and that increased the royalties. Similarly, our payments to First Nations, the impact benefit agreements that we have in place, those are again a function of the gold price. If the gold price goes higher, then they do better. And so as a consequence of the rapidly rising gold price, mm-hmm. That inflated our costs.
So you're in Mexico, you're in Ontario. Are we talking about royalties paid to governments here or to streaming/royalty companies?
So we have no royalties other than a government royalty on our Mexican operation. It's a 1% government royalty payable to the federal government in Mexico. Mm-hmm. In Canada, it's there's no government royalties on our operations. These are our royalties paid to the various royalty companies that you would know.
Now, you pulled off an acquisition last year, Mino. You bought Argonaut Gold, and that is connected, or it's linked to your crown jewel, the Island Gold Mine in Ontario. So tell us, what are you doing at Mino?
So yeah, it's pronounced Magino. And that operation, effectively, we acquired it because the company that built it was having a very, very difficult startup. And we telegraphed to the market very clearly that there was a lot of remedial work that needed done in order to bring that operation up to our standard, if you will. And we've been working on that quarter by quarter, and we're just getting there now. So we're effectively running at that design run rate, 10,000 tons a day now. By the middle of May, we should be something like 11,200 tons a day, at which point we're going to effectively close down the existing milling operation that mills our underground ore and combine all the ore we're producing in the district into the one mill. So we're on schedule to do that, but that mine, it had a very, very, very difficult startup, and part of why is it wasn't really designed for the climate in which it was built. And while we had addressed most things, we hadn't taken note of the fact that the ore chutes and and for the ore feed, they were just all too small for the kind of climate that we're in. And so when we hit the middle of winter, certainly getting into February and March, very, very cold weather this year, and that had a way of kind of gumming up the ore flow. So anyway, we've sorted that now, and of course we're out of the winter and we're into spring. Mm-hmm. So we're already doing much better as we get through April and go into May.
I said Ontario and Mexico, but of course you've got your Lin Lake play in Manitoba. When are you looking to get to production there?
So that construction project has started now. We've got about $100 million budgeted for the capital spend in 2025. We'll have it up and running effectively in 2027. And we're effectively right on schedule to do that.
But Ireland is still your crown jewel, still the biggest part of your value?
Indeed. I mean, Ireland, we had a terrific year at Ireland in 2024. And the big surprise there is not only did we have an overall increase in ounces by roughly 34%, but the grade went up by 11%. And that's remarkable. Generally, when you have a big increase in reserves and resources, it's typically at the expense of grade. In this case, not the case at all. The more we're finding at depth, the higher the grade is. And so overall, it's bringing up the grade of the deposit. And, now in all categories, we're sitting just under 7 million ounces, and that's net of 1.2 million ounces of depletion. There's very little doubt in anyone's mind, certainly not in industry analysts and participants, that deposit's scheduled to go to something north of 10 million ounces. It's really remarkable, the pace of growth that it's undergoing.
Now, your stock has gone up a lot. Your market cap now, north of $15 billion, or it has been lately anyway. Your free cash flow, according to National Bank, which has a buy on you, has it going from 230 million last year to about just under 240 million this year. I guess that's partly because of capital expenditures, and then jumping to almost 430 million next year. Why would your free cash flow jump so much next year? Is that because you're putting Mino costs behind you?
Well, there's a variety of reasons, but it's mostly because you'll see over time our capital spend is going to come off. I mean, ultimately, if you assume the gold prices that we're enjoying today, we'll see in excess of $1 billion in free cash flow as our capital spend comes off. Mm-hmm. Keep in mind, we're still undergoing a fairly heavy capital spend for the expansion of the Island Gold Mine. We're still sinking a shaft and building all the infrastructure to support that. On top of that, we're building a new underground operation in Mexico, and we're building a brand new mining operation up in northern Manitoba. So we have, 3 fairly substantial projects under our belt right now. But over time, we'll complete those projects, and that will mean more production coming on, and that'll be also very low-cost production. And at the same time, the capital costs will be coming off, and so that's why our free cash flow will continue to grow.
John, we've only a minute left, but give us emotionally, what is it like running a gold company with the gold price hitting 3,500 last week?
Well, I've been asked many times, did I ever envision it going here? And, in fact, I did. I mean, it almost sounds like you're bragging or something like, but why would you be running a gold company if you didn't believe in gold, first of all? And secondly, if you looked at what we were doing, it always looked ahead to a point in time where the gold prices would be better. So, we were aggressively making acquisitions from 2014 through 2017 at very attractive prices relative to where we are today. Gold was trading between $1,100 and $1,300 back then. And now we're seeing gold in excess of $3,000. And that's how you get to $16 billion.
John, thank you very much indeed. Really appreciate it.